What's up guys, it's Matt, the Fruitful Investor. So what's the best investing strategy for most people? Well, if it was up to Uncle Buffett, he'd tell you to keep indexing. Index funds are great for those who don't want to pay a ton in fees in active management, and for those who want to invest passively without spending hundreds of hours analyzing a million different stocks and companies. I would argue that the best investment strategy for most people is to put 100% of their funds into index funds and only look at it once a year. So in this video, I'm gonna go over what an index fund or an ETF is, their benefits, and what I think are the top 5 and what you should be investing in for the long term for pretty much guaranteed wealth. Let's get into the video. Alright guys, if you're new to the channel, I've been investing in real estate since 2011. I've owned over 45 individual rental properties, and I've also flipped over 100 single family homes. With also being heavily invested in the stock and crypto market, business and investing is right up my alley. So before we get into the top 5 index funds, let me explain what an index fund is. Instead of buying dozens or hundreds of individual stocks to diversify your own portfolio, many companies like Vanguard and Fidelity have created funds that pool a number of high quality different companies together. So for example, if we take a jar of gumballs, rather than having to find all the best individual gumballs over time to create our own jar, we can just own a slice of an entire jar that already has a proven track record. The gumballs being stocks and the jar being the fund. In case you didn't make that connection, I just wanted to make sure. Also, one quick thing before we dive in, let me break down the difference between an index fund and an ETF. One of the most popular index fund companies is Vanguard. Now, if you invest in one of their index funds, you have to invest directly through their brokerage, and they often have rules around minimum investments, which is $3,000. If you have less than $3,000, not to worry though. These companies have also made an ETF version, an exchange traded fund, that can be bought and sold on any brokerage app with no minimums. So whether you're investing through Robinhood, Webull, or Interactive Brokers, you can buy and sell these popular ETFs that mirror the index fund version. Now, once I go over these top 5 funds, I will give you the index fund and the ETF equivalent if they have it. But for me, I always lean towards the ETF version as they're much easier to get into and you can invest as low as $1 into them. And because they're more popular, the funds are more liquid and tend to have a larger market cap, which means it's easier to sell stocks and options contracts should you want to get in and out of a trade really fast. So with all that being said, let's get into the 5. Number 1, VTI. This is the Vanguard Total Stock Market ETF, and it doesn't get any more boring than this. If you want to bet on America and own all the stocks, VTI is for you. It's all of America's publicly listed stocks all in one fund. Yeah, 4,100 stocks. Everything from small cap, mid cap, and large cap stock. Now, in the last 5 years, the average yearly return was 12.68%. And for the last 10 years, it's been 13.95%. So really not bad for just putting all your money into one fund and never having to look at it ever again. The second ETF I recommend is VOO, and the index version of this is VFINX. Now, I'm sure you've heard of the S&P 500 before. This fund is the top 500 large cap companies in America, and VOO just mirrors and tracks the S&P. This is by far the most popular fund in the entire world, and this is referred to as the market. The S&P 500 is the market. Pretty much every investment on the planet is compared to this fund. The top companies in this fund are Apple, Microsoft, Google, Meta, Tesla, etc. Great large cap companies that are going to be around for a long time. So over the past 5 years, the average return for VOO has been 13.36%, and over the past 10 years, an average of 14.36% every single year. This is another fund that you could literally invest 100% of your money in and just be done. Not even have to invest in anything else. In reality, no one beats the S&P. The majority of funds or stock pickers, even professional hedge fund managers, never really beat the market. So just chill and invest in the market. Bet on America, and you likely won't lose. The third ETF is QQQ. This is often referred to as the NASDAQ, which this ETF is the top 100 non-financial stocks from the NASDAQ. Now, this is a very tech-heavy fund, so when tech is doing great, this fund does really well. If tech isn't, like at the time of filming this video, it gets hit a little harder than the S&P 500. Over the past 5 years, the yearly return has been 15.99%. And over the past 10 years, an average of 17.54%. So slightly higher than VOO, but a little more risky on a yearly basis. The fourth fund I'd recommend is XLV. This fund tracks the top healthcare related stocks from the S&P. So this fund is also very boring. Why? We always need healthcare. Recessions, corrections, booms, it doesn't matter. These stocks will always perform well. Over the past 5 years, this ETF's average yearly return is 11.63%. And over the past 10 years, the yearly return has been 14.97%. So not quite as high as the S&P, but lower and slower. And last but not least, the last ETF I'd recommend is VPU. This fund tracks large utility companies in America. Again, something we always need through all economic cycles. Recessions or not, these stocks will perform pretty well. This fund has electric, water, natural gas, solar, and more, all energy focused. Over the past 5 years, the average yearly return is 8.97%. And over the past 10 years, the yearly return has been 10.32%. So again, not as high as the market, but on a yearly basis and during bad times, storing some money in this fund might be a good idea. So those are the top 5 ETF and index funds that I'd recommend. I'll wrap up this video by saying how much I'd allocate in each for a nice, balanced, and super diversified portfolio. So for VTI, the total stock market ETF, you could literally just do 100% of your money in this one fund and just call it a day. Super easy, super passive. For anyone that doesn't really care about looking at the news, keeping up with the markets, looking at newspapers and articles every single day, this is probably the best move for you. Just put your money in, chill, relax, and check on it maybe once a year, ideally once every 5 to 10 years. Just leave it. Now for you traders that want to diversify a little more and have more of a portfolio approach to possibly even beat the S&P 500 yearly returns, number one, I'd put in 50% of my money in SPY or VOO, the S&P 500. Now the difference between SPY, VOO, which is the exact same thing, just two different companies, but SPY is much more liquid, also tracks the S&P 500 just like VOO, but SPY is way more liquid. So if you're trying to get in and out of trades, if you're trying to sell options contracts, puts and calls, you probably want to trade more so into SPY. If you're more passive and you just want to put your money in to the S&P and not really trade on an active basis, I just put in the money into VOO. Why? Has slightly lower fees than SPY, but less liquid. So if you're trying to get in and out of trades really, really quick, like I said, SPY. If you don't care so much, VOO. The second fund I put it in is QQQ, which is more tech heavy, like I said earlier. And I put about 30% of my money into there, just to get a little more exposure to tech. So when tech does rally, which when it does, it rallies big, you're getting bigger swings and you will beat the S&P 500 market with that fund for sure. Third, I would do XLV. I would put 10% into there. Even though the returns were less than the market, the S&P, I'd still put some money into there just to change it up a bit and also have, like I said, more healthcare exposure, because healthcare is gonna be around forever, that's for sure. We always need healthcare in bad times, good times, but specifically in bad times, like right now when the market's not doing so well, these healthcare stocks are really carrying the S&P 500 and will carry your portfolio as well if you have some exposure. Last but not least, I would put 10% into VPU, which for a total of 100% of my money. VPU, again, just has some more energy focus. So same thing as the healthcare play. When things are going well, fantastic. All the stocks are doing well. But like right now, when we're kind of in a bear market, we want some exposure to some stocks that are gonna do well no matter what. So again, the stocks here kind of carry the S&P 500 in bad times, and to have some exposure over there, not a bad idea. Anyway, guys, that's the video. If you learned anything, if you like this video, smash the like button. It goes a long way to helping this video get more views, and subscribe to get 2 financial videos every single week. I'll see you in the next video.